Joining us now is Bill Nygren, partner portfolio manager and U.S. CIO at Harris Oakmark. His fund's top holdings include Alphabet, Citigroup, and Warner Brothers Discovery. Talked too much about that already, Bill. I don't know, but we can if you want. Let's start with Google. We just had a long conversation about it with Brent Thill, who covers it. But, you know, it's been a long time part of your portfolio. Obviously, I would assume you're very happy you own it, although you may have trimmed a little bit. You sad about that?
No, not really. I guess it would have helped our returns had we not trimmed, but we think it's important for risk control to not let the market take our ownership percentage way up. Alphabet has been about a 3% weighting in our portfolio, in line with our other very large holdings. And had we not done anything, it would have gone up to about 5%. So we tend to trim into strength. With a lot of the names that we own today, I think you can make a plausible case that in 3 years the stock prices could double. And I have a hard time doing that for Alphabet. I think it's a lower risk name, and maybe a 50% move in 3 years would be pushing it.
All right, so some of the names I think you're referring to perhaps are those that are trading at single-digit PEs.
Right.
Indicative, of course, of a value fund like the one that you run. What gives you the confidence that potentially the market is going to revalue them and or earnings are going to increase that much that they would be a double in that period of time?
Well, part of it is the self-help story of share repurchase. So you look at a company like General Motors, they've taken out a third of their shares over the last 3 years. If over the next 3 years their earnings don't change and they take out 25% more of the share base and the stock sells at 9 times earnings, that would be double today's price.
And are there others that share that same sort of characteristic, in your opinion?
Yeah, I would say so. Delta Airlines has cut their debt level more than in half from the pandemic. Sells at about 7 or 8 times earnings. We think that's too low a multiple for the leading airline company. Think their earnings could be 50% higher 3 years from now, and with an 11 or 12 times multiple, you could get a double. That just doesn't seem heroic to us when you're talking about a market that's twice that.
What do you think of the pair trade of that and Airbnb as well, and what it says about the future of travel?
Well, we like Airbnb because the take rate there is so much lower than it is at other travel-related companies like a Booking. And we think if they move that level up to what Booking has, and we think that's plausible, because Airbnb tends to have small clients on both sides. There's no real power. So we don't think it's crazy to think they could do that. They're investing a lot of money in adjacencies right now. We think those will either eventually be profitable or stopped.
Something that stood out to me in the notes here is this idea that you have that for the first time in recent history, the S&P 500, which just turned negative, by the way, became a non-diversified index. We talk about the concentration all the time. But what are the broader implications, especially for the active management industry, which benchmarks itself to the S&P 500? What does that mean as you...
Well, when you file a mutual fund, you can either file as diversified or non-diversified. And the SEC thinks that non-diversified is such an incremental risk level that they want to make sure that investors are aware of that. If you're a diversified fund, once your holdings that are each over 5% of the portfolio total to 25%, you can't buy any more of those names. So right now, there's no effective way for an active manager to have an overweight on those 4 names in the S&P 500. It's a really unusual position, unusual because we've never been there before. And I think problematic when you think about like what index really makes sense for investors to try to benchmark their portfolios against. Which indexes do a better job of telling them, are they doing a good job saving for retirement, for homes, for college? And I don't think the S&P 500 fits that role anymore.